Graham, welcome to the call.
Hey, how are you?
Good to have you back. Graham's on our call usually once or twice a year, and Graham's been in the mortgage industry for about 20 years now, and is well known throughout the industry as a top producer and an absolute expert on all things lending. And so that's why I like to have him on the call every now and then, because he's kind of a wealth of information. And just a quick little background, when I started in real estate in 2015, when I was buying my first few houses, Graham's the first lender that I reached out to. And it wasn't really by coincidence. I think I was listening to Bigger Pockets or one of the podcasts, and he was a guest, and that's how I learned about Graham. I texted him, it was July 3rd, so it was right before the 4th. Everybody was already off. I was hanging out at the pool, just texted, and Graham called me within 2 minutes. And we ended up doing some loans together. I think my first 5 properties or something like that, I got through Highlands Residential Mortgage. So that was a great experience, and hopefully you guys can connect as well. But the reason why we have Graham on today is because there was an announcement that came out, I think mid-September, that the Treasury has removed some restrictions from investment loans, and that kind of piqued my interest, and I wanted to have Graham on to kind of tell us a little bit more. So Graham, what happened?
Well, I guess for people to truly understand where we were, where we are now, and hopefully moving forward, back in the '08, when we had the mortgage meltdown, the government had to step in and rescue. And so they basically took over Fannie Mae and Freddie Mac and put it into conservatorship. And it's been in conservatorship since. During the course of that time, they, of course, we went through the bailouts, foreclosures, forbearance, the mods and all that kind of washed itself through within, let's just say 3 or 4 years. Say, and I'm going to guess here, let's just say starting 14 or 15, all the monies that was, taken in from the government were paid back. And now all the profits and everything that Fannie and Freddie are making are being swooped off the table by the Treasury. And so the government likes that. Our new administration likes that. But as there was an issuance of a preferred purchase, I keep wanting to say it's the PSPA, Preferred Stock Purchase Agreement, back in January. They wanted to try to take it out of conservatorship, but one of the things they needed to do is they needed to make sure that we are dealing with risk properly. And so there were a lot of adjustments that were made. Some were even made back last year when we were going through all the refinancing. They added an extra G fee, and they were tightening up a little bit on the ratios and so forth. But I think one of the things that when it came out in March, finally, they didn't like the higher risk loans. Low down payments, high back end ratios, debt to income ratios, low credit scores, and then of course followed suit was the second home and investment properties.
But and I would say anybody who doesn't know, let's say folks who are new to the real estate game, and Fannie Mae and Freddie Mac, you hear the terms a lot. There's a couple of entities that are working with the government or are the government. How would you explain Fannie and Freddie?
There are 2 government-supported housings that are backed by the government. Since, I'm trying to remember now, probably since the '08 bust, the government established the FHFA, which governs Fannie and Freddie. Okay. And it used to be ran by a guy named Mark Calabria, I never can say that right. Not too many fans that he had in the last several years. Up until recently, they just changed the guard over, and Sandra Thompson stepped in. I guess it was like February, March. Anyway, during that March time period, I think it was March 10th, they came out with that announcement that they wanted to reduce the high risk loans. Okay, and the second homes and the investment loans were part of it. The industry average before that announcement, delivering loans to Fannie Mae and Freddie Mac, because all lenders, when they originate a loan, they have to sell them off. They don't keep any of the loans. Even the big boys, they don't keep the loans. Very few companies do portfolio their own loans. They want to sell them off, make money, and they just keep going.
Because that way they keep turning the money. Let's say a company has $100 million to lend. They're able to keep turning that same money by selling off the notes every time they issue a loan.
Exactly. Right? There's 3 entities of originators. There's the mortgage broker, which they will bundle up the information the same way everybody does, all originating loan officers. but they have to send it across town or out of state to someone else to process, underwrite, and close, which will be in that particular lender's name. And then there's correspondent lending or mortgage banker, which is who I work for. And we have our own money to work with, or in this case, we have lines of credit that we use. So we'll process, underwrite, and close all the loans in our name. And most of the time when we deliver to Fannie Mae, we'll even service the loans, but the notes themselves are always sold off. The banks do the same way. So one of the things that we ran into, or should I say, when this mandate came out, the industry was averaging about 16% investment properties and second home compared to primary residence. And they wanted to cut us down to 7 in a very short order. The announcement came out in March and they said, okay, you got to fit in this box by May. It was impossible because they went.
That would mean that Fannie and Freddie would not buy the loans from you. If you wanted to issue more loans than 7% or whatever, they would not buy them from you.
Well, they would, but they were limiting us. Okay, maybe I didn't explain myself. Okay. In other words, they came to us and said, okay, we don't want you to ship us any more than 7% on a 52-week basis. Well, we couldn't really establish the 52 weeks. So we went back to the first of the year. So come March, we were already at 14 or 15%, and they wanted to slow this fast moving train to 7% by May. It was an impossible task. So a lot of lenders just stopped doing investment property loans. A lot of lenders tightened up on their guidelines. We actually were still doing the loans, but we found aggregators that we could deliver it to, people in Wall Street other than Fannie Mae and Freddie Mac. So what we did is we stopped shipping to Fannie and Freddie to get those percentages down. Heck, when we got to the end of May, we were still at 10%. And it was interesting because our company has grown so much that they changed our Fannie Mae rep, and the rep came back to us and says, you know, between now and year, and I think we're going to dig you down to 3. So the guy that runs our secondary, he was just, I mean, he was doing everything he could, and he did an excellent job by finding aggregators or servicers other than going directly to Fannie or Freddie that were shelving these loans. They weren't counting it against us. So for the last 6 months, we really haven't been selling hardly anything to Fannie Freddie. Well, of course, we're selling the primary residence, but second homes and investment properties we weren't, because we didn't want to get penalized, or we didn't want to get cut off by Fannie Mae. And so we were selling a good chunk of them to 4 or 5 different aggregators, but the price was higher. And what happened is when this whole thing came down, the industry took about a 200 basis point hit on a minimum, okay? That really reflects into about 1/4 point in rate. So if we were at 3 1/4, all of a sudden it just sprang up to 3 1/2 overnight, okay? And some were even worse. And so we went through about a month and a half where we were taking rates that were in the 3s and immediately threw them into the 4s. And some of our competitors that may have not have had the challenges that we had of fitting in that 7% box, they were pricing their loans in accordance to the direct delivery to Fannie. So we had a little bit of competition there. We managed to make it work for 6 months. And then all of a sudden, 3 weeks ago, the Treasury and the FHA got together, and because they were getting a lot of pressure, a lot of information that was being delivered from the National Mortgage Banking Association, national brokers, all different entities, probably even the National Real Estate Association, say, hey, you're trying to slow down an industry of the second homes and investment properties that is on an increase of 83% annually, and you're trying to slow it down. It makes no sense. And so they said, okay, you're right, it doesn't. So they lifted the rule. So it's kind of business as usual. But don't think we're going to come out of conservatorship for the next 4 years. I think the administration wants to keep that money, as I say, swoop that stuff off the table and keep those profits. Trump was more of a businessman. He really kind of wanted to take Fannie and Freddie and turn it into a business, okay? And that's why when he was dealing with Calabria, they were coming up with all these, guidelines. How do we make these 2 entities work stand alone? Because they were standing alone back in 2008, and they were doing just fine until all of a sudden they were delivering bad loans, the whole 9 yards. The whole thing had just imploded. So it was a snap decision to put that into place. 6 months of very difficulty for the lender, and even the investor for that matter, because they had to take a price increase on the rates. But the rates have come back down now, are more in line because we don't have all those adjustments. So it's been it's been fun for the last 6 months. So
the
bottom line
demand
is,
has been going up both for regular residential properties and for investment properties in particular. It went by over 80%. I think in the spring of this year over year, it was over 80% up for investment properties and vacation homes. And obviously for regular residential properties as well, for people to live in, the demand has been going up, the prices have been going up, the supply has been going down. And so what the Treasury is doing now is to try to help that, I guess. Is that right?
well, I think Biden, he is a fan of the housing administration. I think he wants to, keep pushing the low to mod housing. He wants to put people into housing. Personally, I don't think he likes people with money, which is everybody on this podcast. He doesn't like the investors. I mean, think about it. He's trying to take away the 1031 exchange. I heard the other day he's trying to tax the IRA, the people using those IRAs to go buy houses. And when they sell those houses and put the money back in the IRA, he wants to tax that. It's crazy. That bill is on the table.
I wasn't happy to see that. We actually had somebody on as well. A couple of weeks ago, we had someone on talking about, it was a 1031 facilitator and talking about the same thing. But with 1031 exchanges, if they were to go away and how it would impact investors, that was pretty devastating.
But I'm in the middle of 3 right now. I mean, it would kill my bottom line if I had to take the hit. I mean, the 1031 makes sense. I mean, it was set up for a reason, is to help people grow their wealth. Okay. And you or I are trying to do just that. And for some reason, the administration, they don't want us to grow our wealth. They want their share, if you will.
So I've always said to everyone basically that there's a reason why real estate has the tax benefits, right? It's not just because it's a loophole or government somehow didn't know that real estate investors are not paying a huge amount of tax. It's for a reason. It's because we revive communities, we create jobs, we hire roofers, plumbers, electricians, contractors, insurance agents, real estate agents. All of those folks have jobs because of real estate investing, and that's why it is subsidized heavily by the government. So ending that is kind of shooting yourself in the foot.
Exactly. I hope I've explained it well. It's kind of a gray area for me. All I know is that the president of our company came to me on March 10th when this mandate came out, and he calls me because I was doing a lot of loans for the company that were investment property loans. And he came to me and says, "What do you want to do?" And I said, "Well, I'm not sure. What do you suggest?" He says, "Well, we can just cut the company off and just let you just continue to do loans." And I said, "Yeah." And then the next day they'll be on my lawn mutiny, trying to burn my house down. So we didn't go for that, which was good. And so fortunately, one of the guys that's in charge of our secondary runs operation, him and the lady that reaches out to all of our investors and the Wall Street providers, they did an excellent job to keep us in business. Because a lot of the banks had to shut their door, well, not shut their doors. They had to stop delivering investment properties and second homes to Fannie and Freddie because they only had 2 outlets, Fannie or Freddie, where we had other different outlets. So we were fortunate in that whole thing.
So the aggregators that buy the loans, you said they buy them at a kind of a higher price, and they would basically hold them for a while until the climate changes, and then they would still end up selling them to Fannie Freddie eventually, or?
That I can't tell you. I'm not that sophisticated in the secondary market, but we had like 4 or 5 that were buying our loans, and their prices were higher. You probably know them. That Flagstar, actually Chase was one of them. PennyMac was another one. North Star Bank, which they're up out of the Midwest. And I can't remember, there was 2 or 3 others that were buying these loans, and we'd figure out, and it was good because they knew that a lot of people weren't delivering these loans to Fannie. They jumped in on this opportunity, which I'm glad they did, and they got their pricing in line where their pricing normally is not in line. Okay, so they got their pricing in line, and then they kind of found out that they're not the only ones jumping in and seizing this opportunity. Somebody else is doing the same thing, so the pricing got even more competitive, which is good for us and the consumer. And that that lasted all the way up until a couple of weeks ago. So it's been interesting.
That's really amazing. So what happens with rates in the future? crystal ball, I mean, where are we going? Where are we going to be a couple of years from now, 5 years from now? Is there any way to know?
Well, if I knew that, it'd be living on Wall Street. I, I would say at least going to be flat till the end of the year. I'd say if we see any increase at all next year, I'm hoping no more than a quarter to a half, for the rest of the year. And then after that, I mean, your economists are going to have to tell you that. You'll have to get them on your webinars. But I suspect that the housing might, because I'm actively buying, as you know. I closed on one Monday and closing on one Friday. And as you say, the housing prices are going up. It's, that rent to ratio is getting further and further apart. That 1% is going out the door quicker every day. And so it's challenging for people that want to buy right. Like Nick in Alabama, he's got houses that he's selling that makes sense. Okay. You go to Florida and try to buy a new build for 300,000, it's bringing in 1,300. That doesn't make sense. Okay. So, but the inventory is not there like the ones Nick is selling. So it's very difficult and challenging for people like doing a 1031 exchange or just trying to grow their portfolio in general. So I'm hoping that this forbearance will take full circle this year, which, to be honest with you, I don't think it will, but we'll see. If it eventually takes full circle, then maybe we'll start seeing some of that inventory come back on the market. Okay. But we all are very optimistic in that area.
Yeah, we had actually last week, we had Lance Lambert, who is a journalist and editor at Fortune magazine, on our call, and he was talking about exactly that. What happens with those 1.4 million or whatever they're remaining on forbearance that are about to end, and are they going to put their home back on the market? The estimate was about 25% of those homes might end up on the market, which might help the supply a little bit. And then a lot of the buyer fatigue from getting declined or from getting their offers rejected for so many months. Some that will just kind of give up, and that might help the supply as well. I know we were one of them. Actually, I was telling you the other day that we almost became neighbors because I was in McKinney just a couple of months ago, and we were making offers on houses, and people are offering 40, 50,000 over asking price and still getting bid out. And eventually we did get under contract on a house that couldn't have been far from where you are, because it was in McKinney on the Summerlin.
I'm in McKinney, yeah.
Yeah. So we got the offer accepted. We were under contract, and the more we thought about it, the more it just didn't feel right. I mean, probably the house after 2, 3, 4 years, it would have gotten to where it would be. Where we were paying for it probably would have gotten to that value, but it just kind of didn't make sense, the whole thing. And we have family in upstate New York, so we ended up moving there. But yeah, there's no better example in the country than the area where you live for what's been happening with prices.
We and this is my personal opinion. We probably, on an average, up until probably 13, maybe 14, our appreciation here was probably no more than 5 to 8% going down the hill with the wind behind us. That's the way we were. But back in the 08, when we had the bust, our depreciations were only 2%. So we've always had a really strong and stable market, kind of like Alabama, very strong and stable. Ohio, strong and stable. But I mean, this last 5 or 6 years has been completely bonkers. This double-digit growth, I've taken advantage of it because I've sold 4 houses that I've owned for several years and did exchanges. I've got one on the market. I'm thinking about selling it again, but yeah, it's stupid. It is, but it is what it is. I mean, the same thing's going on in Florida, Atlanta, North Carolina. All these other markets are experiencing the same thing.
Yes.
It's very difficult.
Yeah, we've loved seeing the ride, and it's been great. We have somebody on the call from Atlanta now. But anyway, yeah. So the other thing that I wanted to touch base on a little bit was last time you were on the call, we talked about kind of general things. This is the type of stuff that we've covered so far, is the type of things that I like to hear, that a lot of experienced investors like to hear. For our newer investors who are on the call, I guess for them, the most important thing is, how does this affect me? Let's say I'm trying to buy my first investment property now. It sounds like things are going to be marginally different than they were before, a couple of months ago. It might be a little bit easier to get an investment property loan.
I'm going to say it's about the same. Okay. During that whole craziness during the last 6 months when they put this mandate on, you would think that it would have affected the guidelines, reserves, ratios, and so forth. For the last 6 months, I've still been selling all the way up to 50% back end ratios because, because we got a, low LTV and 80% loan to value or less. I mean, if those type of loans were owner occupied with a 97% loan to value and you had above a 45 back end ratio, well, then chances are the underwriting engine would not accept the loan. And that's how it works. You just, we gather 3 categories of information. We pull your credit. We look at how much money you make and how much money you have. Goes into the loan application, uploaded into this thing called desktop underwriting in the sky, which is the Fannie Mae underwriting engine. And we get an answer within a matter of seconds. It comes back and says approved, eligible, or not. And I haven't seen anything approved ineligible for high back end ratios, any reserve requirements or anything. So really, to be honest with you, I haven't seen any effect in the underwriting guidelines in the last 12 months. Okay. I really haven't. It's been good.
Okay.
Now, when we were delivered to aggregators, they may have had overlays, and there's some lenders out there that might have had overlays too. And overlays are addition. What we did, we're straight Fannie lenders, which means we underwrite in accordance to Fannie Mae. We get the documents, upload it, comes back approved. The underwriting engine says, give me a pay stub, a W-2, and a bank statement, and we're funding the loan. We ship it to Fannie. We're good. And we still do that same thing today, even with the aggregators. Sometimes the aggregators will come back and say, well, we really want a 4th grade report card in there. All right, fine. They would come up with something stupid. They really would. But the fact of the matter is we're straight Fannie. We have no guidelines. It's easy breezy. And I don't take a loan on. I don't waste your time or mine unless I know I can get that approved. And I know right on the front end. Once I get your application, your docs, I'll know good right there on the front end. My guys, my assistants, I mean, they should be underwriters. They really are good. But yeah, I mean, we've hardly turned down anybody unless they had a bankruptcy they didn't know about and they didn't tell us, oh yeah, I had a bankruptcy. Well, that doesn't go. So if you think you can fool the lender or the underwriter, you can't, because we have so many mechanisms that we can find out. So be forthright and honest with your loan officer, regardless if it's me or anyone else, because that's the only way you're going to get a loan.
So one part about obviously underwriting and shipping loans to Fannie and Freddie, you have to be in a certain box that they want you to be in. It has to be within certain parameters and all that. But the good thing is that once you kind of have those parameters down, for a new investor who's buying their first, second, third, fourth property, it's pretty straightforward. I remember, the first time we were doing a loan together, I sent you a ton of documents. As you do with any lender, you just send a ton of documents in. But I remember by the time I was buying a third and fourth one, you pretty much asked me, I would send you the address. You would ask me, hey, can you send me updated pay stub? I would send it to you and you say, we're good to go. And that was pretty much it. So that's how easy it became. But then once you get to a certain number of properties, and last time you were on a call, I was trying to remember all these numbers and everything I was saying was completely wrong. So I'm not even going to try. But can you explain kind of the difference, 1 through 4, 5 through 10? What are the differences there?
I'm not sure if I really understand that question.
It might be outdated. My question might be completely outdated, but loan number 1, 2, 3, 4.
Okay, all right. Let me take
5 through 10. Yeah.
Once again, back to the original credit, earnings, and assets. It's all math. Okay. So we take a look at how much money you make, what kind of debt load you had, adding the new debt load for the house, and then we do the math. And if the math, by taking the income and the debt and dividing into it, comes up with a quote ratio, that ratio itself is below 50, which is the tolerance level, then we're good to go. Now, one of the things for people that are trying to be aggressive and they're buying one and then turn around buying another one and so forth and so on. If I can approve you for 1, I can approve you for 10. And here's why. They're all income properties. They all have income, which offsets the liability. Okay. So if you buy property number 1, you go get a lease right away, it offset the liability on that loan. You're actually a little bit better on your back end ratios, because if you bought right for cash flow, well, you're going to have additional cash coming in. Okay. So 1, 2, 3, and 4. So a lot of times people, when they're doing exchanges, they got $500,000 to $750,000 or whatever the case, and they're out buying 5 or 6. So the first thing I do is run the numbers to make sure, okay, if we had to do 5 in a row without leases, can we do it?
Mhm.
About half the time we can, half the time we can't. So when I'm dealing with these people, I say, when you're, talking to the real estate agent, a real estate provider, a turnkey provider, whoever, make sure when you're buying these properties for this exchange, make sure they have a lease, okay? Because if they don't, that could slow the progress down, okay? So that's if you get those leases on those properties, then buy as many as you want, as long as you got the down payment closing.
Well, the cool thing is if you're buying, especially if you're buying turnkey properties, because if you're buying them turnkey, then it already has a lease in place. It already has a tenant in place, so you can buy another.
Not half the time.
Yeah.
About half the time. Because a lot of times on these turnkeys, they're selling those properties so fast, they're putting contracts on them even before they're done. And so once they're done, they want to close. Fine, we'll close. And of course, they're trying to solicit the renter at the same time. They may have a tenant in there about the time of closing. They may not. But I would say on average, no more than 30 days.
Okay.
It's just because the demand is there.
Yeah. Yeah, I agree with that. And I've actually gotten into that as well because, we just kept seeing this. I was helping some friends, Nick included, and Lee in Alabama. I was helping them sell the turnkeys and just talk to folks in our group and just say, hey, who wants to buy a turnkey property? And it got to a point where neither one of them had any inventory to sell, because they have 10 buyers for every property that becomes available. And so what I've started doing now is, with the flips that we do with wholesaling that we do, we are going to sell a lot of them as turnkeys. So if anybody is looking to buy a property below market value or very close to market value, I guess, that does have a tenant already in there, that's already rehabbed, that has new flooring, new HVAC, new roof, whatever it may be, and that's already cash flowing, feel free to reach out to me as well, and to Graham, I guess, if you do need a lender. So,
there's 2 schools of thought, in my opinion, for real estate. You can go out there and battle on MLS. If you get the contract, or if you do get the sale, then you got to rehab it. Got to find the contractors. Then you got to put a tenant in. Then you got to manage it. All that. Or that's where the turnkey comes in. They do it for you. The downside is they're going to sell it close to retail, where if you did the whole exercise on your own, you're going to have some, quote, built-in equity. Well, unfortunately, I've got a full-time job. I don't have time for all that. So I do rely heavily on turnkeys to do that for me. I just, and even if you find a different management company, that's still one of the keys to success. You can go through that whole exercise with a turnkey or do it on your own. But if they have a crappy manager at the end, it's all for naught.
Yeah.
So management, in my opinion, is probably the most important.
Yeah, and even retail price for a turnkey property makes sense still if the rent to value ratio is right. It's getting harder now in the market to find that coveted 1% rent to value ratio on a turnkey property. I can say with confidence that any of mine are not going to be ever under 1%. In fact, they'll be slightly over 1% normally. And a retail price for a turnkey property might make sense a lot of times, because if they already have new flooring, new roof, new HVAC, a lot of these systems that are brand new, it makes sense for an investor because they don't have a lot of expenses in their first year.
Yeah, I kind of, because of the lack of inventory and doing exchanges, it's just very difficult and time consuming. And I don't have the patience. I really don't have the patience. I got 45 days. I got to find something. And I don't want to settle. Okay. Yeah. And so that's your biggest challenge on the exchanges. But I've gotten to the point now, but because of the low inventory and trying to achieve that 1%, and the fact that I want to keep my maintenance down, I don't really buy anything under probably 1990 anymore, all the way to new build. And the last, 7 or 8 properties have all been new builds. I closed on one Monday, $245,000. I'm getting $1,895 rent. It's not 1%, but it ain't bad.
It doesn't, and that's the good thing. Once you get to that level of a tenant, so a property for $245,000, you're not going to have a bad tenant in there typically, right? You're going to have a pretty decent tenant that stays there for a while, that moves in with a family, and for those type of properties, you can be under 1% and still do really well. Because I've noticed that for low end properties, you're in Detroit or like a bad neighborhood someplace, a low end property is going to look really good on paper. It's going to look like it's going to have a lot of cash flow.
Exactly.
Whereas a high end property might look as a small cash flow property, but it might end up doing better for you in the long run when you actually draw the line at the end of the year.
That's really what I've been doing. I got rid of my C and D properties, and I'm focused on no more than probably a C plus to B minus, because you got to pick your poison, either A, B, or C. And then, the C's and D's, like you said, on paper look great, but the low demographics, age of the product, the maintenance is going to come back quicker than the new builds or whatever. That's why I keep mine at 1990 or more. So I know I still got an HVAC that still may be working okay, or whatever the case may be. Roof may still be good.
Yeah, nobody likes headaches, right? So A, B, B minus, that's the place to stay, right?
That's where I'm at. Don't follow me. I mean, do what you got to think is best for you.
Yeah. We have a question from one of our members. Matt Everling is asking, do you have to be a landlord for a certain period of time before the rent can be counted towards the DTI ratio?
No.
Okay.
Some lenders will not give you credit for, if you're buying one property, they will not give you the rental credit. The majority of them do. Normal Fannie lenders will. We will actually, some will do this, some won't. We will actually give you average market rent, because the normal Fannie lender, let's say you have a $100,000 property, you're able to get the 1% rule. So you got $1,000 coming in. We're going to give you 75% credit on that $1,000. So we'll give you credit back on your income for $750. One of the things we do, or a lot of people don't, is, let's say it was empty. Well, I don't have a lease. Well, how can I give the credit? When we do the appraisal, there's several reports inside the appraisal, except for the 1004, which is a standard appraisal for owner occ. We have a 1007, which does a market analysis on the rent. And then, of course, the 210, which does the operating income. But your 1007 is going to give you an average market rent, which from what I can tell, is right on the money from what the management company will rent it for. So we give you credit on the average market rent. And let's say it was $1,000, no problem. I'm still going to give you $750 credit.
Wow.
Now, one thing, if you're doing two properties, we'll give you income on that subject, but that other one, if you need lease income on that second one, you better have it leased. Okay. But if you're doing it one at a time, we'll always give you that credit up front on the rental.
Okay. Yeah, that makes sense. And it's really nice to not have to have a certain period of time of or experience or track record on any of that. You have the income, you have the lease.
The landlordship is an old rule. It's been around a long time ago. Even in the portfolio lending world, or outside the Fannie box, which is where I'm at, they still ask for stuff like that. And there's a lot of lenders, you have to have a couple years experience, so much in the bank, so much equity. So, but in the Fannie world, no, you can buy it. Okay. It doesn't matter.
Yeah, I was filling out a hard money form this morning, and I had to put together a track record, because it's a new person I haven't worked with before. So I had to put together a track record. Still gets asked for sometimes. Good to know you don't have to have one working with Highlands. So Matt, yeah, thanks for the question. Anybody has questions while we're chatting, you guys can just put a question down in the chat box below. So feel free to ask anything you want. And let's see here. So Graham, so how did you get started? So you were doing loans for about 20 years. How did you get, at what point did you say, hey, I want to do this? Did you see real estate investors getting loans and see them making money on it and just go, hey, let me do that as well? Or
that's exactly what happened. There's a guy I'm still friends with today, and he's still my accountant. He lives in San Jose. He came to me back in 2000, I believe it was. Was it 2000? Yeah. And I was working for Washington Mutual at the time. If you can remember that back that far, they're no longer around anymore. But Washington Mutual, they actually had a waiver with Fannie. We have a up to 10 right now. Fannie Mae had a waiver with Fannie Mae. Washington Mutual had a waiver with Fannie Mae. They could do unlimited. So I was living a dream with Washington Mutual all the way up to about 2004. But anyway, this guy came to me from California. He had about 400 doors. He goes, I need to refinance some loans because rates were coming down to 2000. So he threw me 20 at one time. So I got them all done, knocked it out of the park. He goes, hey, that's great, man. I'm going to give you another 20. This industry, Peter, I don't need to tell you, is a lot smaller than people think it is. Everybody talks. Okay. Next thing you know, he told a friend, he told a friend, he told a friend.
Mhm.
And then I started doing all these investment property loans. And I did them all the way up to the '08 bust. And then, the market tanked, the industry was difficult. And I tried to run away from this business. I really did. But about 7, 8 years ago, I said, you know what? I can't run away. I'm just going to embrace it. And when I did, my volume just went through the roof. I did about over 1,000 loans last year. And I don't know if everybody knows that, but that's quite a few loans a year for any originator. But I got in the business back in, I started investing when this particular guy that I did the 20 and 30 loans for, he says, why don't you, look at getting into it? And I kept looking at his tax returns and kind of going, and these other guys' tax returns with all this inventory, making all this money on Schedule E. I said, what do these guys know that I don't? Nothing. They're just doing it. And so I said, well, let's do it. And I bought my first house from him, sight unseen. It was a little condo, believe it or not. I said, I'm just going to try small. Okay. So it's $30,000 condo I picked up here in Dallas. And then once I dipped my toe in the water, I ended up buying like 8 the rest of the year. And I've been doing it ever since. Now, yeah, the '08 bust, that I was up to about 28 or 30. So I ended up selling about half my inventory, kind of get that more in line. And then I started aggressively getting back to it, probably 15 or 16. So my loan that's closing on Friday will put me at 41. Nice. So if I get to 50, I think that's my golden rule there. If I get to 50, that'll give me the opportunity to look back and tell people where to go or keep going. I don't know. So I'd like to have that opportunity, but that's kind of my goal.
That's really nice. Yeah, no, it's great to hear that. And I don't think I ever told you, but I was marketing in 3 different markets so far with wholesaling. And one of the markets was right smack in the middle of Alabama. And I was sending, I think, 2,400 mailers or something like that, direct mail pieces to homeowners of properties that might be investment properties or, that might be owners for a while, whatever it may be. And as I was sending it out, I shot out the whole campaign. And then I went through the list to kind of clean it up a little bit. And one of the homeowners was Graham Parham.
I've got 4 down there. I like Montgomery. I know Nick does too. I like Montgomery. I'm gonna still go buy it in Montgomery. I have a little bird dog down there right now. She's a little real estate agent. She manages all my properties, and but she shoots me stuff all the time. Once I get to this exchange, which I got 4 more to do at the end of the month, I'm going to start buying again. And Montgomery, and I keep telling you, it's really difficult to buy right now. Look at Montgomery. It's still a pretty good market to buy. I can get real close to 1% down there.
Oh yeah, absolutely. Yeah, absolutely. I moved when I was moving to upstate New York, we were moving because we had the only family we have in the country was in upstate New York. And the moment that idea came about, I just thought, wow, this finally for the first time in my life, I'm going to live in a market where I can actually invest right where I live, and it's going to make a lot of sense, and it's going to be over 1%, and still be able to find great deals and good houses to flip. So that was pretty exciting, because before that we lived in Orange County. It just never made sense at all.
Well, good luck up in state. I know some people have had some success in the years previous. I haven't heard of a lot of success lately, but I wish you well.
Well, perfect. You will now. All right. So we got one more question here. Yep, that's a question we inevitably get when a lender's on the pod. So what are the interest rates right now? Or let's do 2 things. So residential, homeowner, roughly ballpark, and then for an investment property, first time investment property buyer.
I'm going to give you investment properties because that's all I do.
Okay.
I'll be lying to you on owner occ, but I'm going to say it's at least a half a point or more difference. But so we like several today at 20% single family down, 740 credit or higher. We locked at 3 3/4 at 0 points.
Wow.
25% down would bring you probably 3.375 with no points. Okay. I don't necessarily recommend buying points these days, since we're back in the Fannie world, and the 1 point typically will get you a 1/4 point better in rate. And when you look at that on paper, it's about a 5.11 year return to do that. I try to keep it within 3 to 5. So I don't recommend buying points. Back when we were delivering to the aggregators, it actually made sense, but those coupons were all over the place. I mean, I could get a 0 point pricing with those guys one day at 4.25, and 1 point would get me to 3.5. Well, that's a no brainer.
Mhm.
So, but that's kind of gone away since with the Fannie improved the price, but narrowed the margins. Does that make sense?
Yeah, absolutely, it does. And
Yeah.
I think, and this is one of the reasons why I liked working with you, because it was, you're a real estate investor as well. And I remember, listening to these points, to these numbers now, it's really interesting because when I was buying my first properties in 2015, I remember we were at like 4.75, and that was really good. I was really happy
Yeah.
to get those numbers. And like you mentioned, yeah, the investment property loans are always going to be about half a point, maybe even 1% higher than regular residential, home buyer loan. But the rates that are around today, I know none of my properties have those rates.
Um, if you're thinking about refinancing, here's my rule of thumb. Rates are important, but dollars and cents is still the most important thing.
Mhm.
If you're considering refinance, and let's say somebody offers you a whatever rate, okay, and that rate, multiplied or factored into the loan amount, a new loan amount gives you a principal and interest payment. Take that amount, the new amount, and compare it to what you're currently paying. And if there's at least $100 to $150 difference in payment, then it makes sense for you to refinance. If it doesn't, don't. I have people come and buy, $100,000, $125,000 houses and come to me within less than a year or less than 2 years. Well, there's not enough time in there for it to make sense. Time, at least 5 years, the numbers would make sense. Even if they drop, had it at 5, you drop it to 4, there still may only be a $60 savings. Okay.
Yeah.
Because you still have the same closing costs you got to justify. That's why I try to keep it within 3 to 5 years. And I think the sweet spot is at 100 to 150.
Okay. Yeah, good deal. That's a good little rule of thumb for everybody to remember, especially if you're first just getting started. Don't refi your house after 1 year. And if you're not saving at least 100, 150 bucks per month by doing the refinance, don't do it, because it'll take you way too long, over 5 years, to recoup your money.
Now, do you have a lot of Burr people in your group?
I think a lot of our members, I would say typically on a, Matt Everling said in chat, he said yes. Yes, there's definitely some Burr people in our group. There's also a lot of folks who are kind of brand new or just getting started in real estate as well. Typically, ever since I started posting our call videos on the website and on YouTube, I've noticed that less people join us live and more people watch the videos afterwards. But everybody I've talked to, I'd say probably 80% new and 20% either Burr investors or flippers, wholesalers.
I like to make sure everybody understands the Burr end result. Was it buy, rent, or buy, repair, or buy a rehab, rent, and then
Refinance and repeat.
Yeah. I was going to remember that.
Yeah.
Okay, so I'm at the end there. So in the first 6 months, you can get your money back, but let me explain how it works.
Mhm.
Let's say you bought retail through a turnkey provider, and so you paid $100,000. Well, chances are, if I appraise that tomorrow, it's going to be at $100,000. Well, the thing about it is, when I appraise it, I'm going to give you 75% of that value. I will give you the full 75% back to you. Now, in the first 6 months, I'll do that. In the second 6 months, it doesn't matter what you paid for it or any of that nature. And the reason why I'm saying this, let's say you pay $60,000 for a house. You threw 20 into it. You're into it for 80. And then you come to me after it's rehab and say, okay, I want to rehab or refinance it. And I get $100,000 appraisal. Well, I'm going to give you 75% of the appraised value or what you paid for it, whichever is lower. So in this case, I can only give you 60,000. So keep that in mind for the Burr people. If you're not anxious for your money right away, wait 6 months. Okay.
Yeah, we have Nick Chambra on the call, and he actually just went through that. But he bought a duplex and was trying to do a refinance and was told kind of the same thing: wait for 6 months to be able to do that. Makes a lot of sense. And I know for me, I'm going to be basically it's hard money, and then if it's a keeper, refinance into a regular loan, I guess, after 6 months.
Well, no, let's talk about that, because what that is, that's not a cash out.
Mhm.
That's a rate and term,
Okay.
which means that you have a lien against the property. There is no seasoning.
Okay.
If you bought it and hard money gave you purchase plus, and you're at 75,000 with the hard money, appraises for 100, I'm going to give you your full 75 because I'm going to refinance the principal balance
Mhm.
as well as the closing costs rolled in, as long as it doesn't exceed the 75.
Well, that's amazing.
So the hard money you can do, there's no seasoning.
No, but you and I are both over 10 loans at this point. And so for us, kind of rules change, right? Because we have to, like the last loan that I got was a portfolio loan. The last refinance I did was a portfolio refinance. And if I want to buy a single house right now with, Fannie Freddie conforming loan, I can't do that, right?
You can, nor can I. Okay. And I hate to say this, but I just closed on my loan Monday, and which was 3.5. Closed on one Friday, 3 5/8. There's life after Fannie. You and I both know that. Okay.
That's good, yeah.
You may have to go through a little more weird underwriting, if you will. Some of the requirements may be a little bit tough. They don't think rationally. They just don't, but they serve a purpose, and it's good.
Yeah, good deal. The last lender I dealt with told me to pay off my car loan and then to refinance my car after I get the loan. So that's what we're doing.
I had one. I know what it was. Since one of my bank statements was a joint account with my wife, the underwriter come back and says, "Who is this Jamie girl? Same last name. It's my wife." I had to write a letter stating this woman is my wife. And then some of this stuff doesn't make any sense.
And I love her sincerely, Grandpa. Oh, that's perfect. Yeah, that's how it goes. But it's fun. And, I know that one of the pieces of advice that I always give to new investors is don't think about how you're going to buy your 10th property or your 15th property. Think about the first one.
Exactly.
Right. And when you buy the first one, because I know that if somebody told me in 2015 I'd have as many properties as I have now, I would say that wasn't possible, right? Because you just don't know what's coming down the road, and you don't have to know is the point. You have to buy the first one, you have to buy the second one, and just do it whenever you can.
Yep.
Don't try to time the market either. Well, we are getting closer to that time. I just wanted to kind of see if you have any final thoughts for our folks, and we'll kind of start wrapping up.
I think that the rates will be steady, as I said, for a while. If the inventory comes around a little bit more, grab it. Don't hesitate. If you are working with a turnkey provider and you got pre-approved, let's say you came to me, got pre-approved. One thing that I do know about well, any inventory for that matter, but like a turnkey provider says, okay, we got this one property just came on the market. Do you want it? If you don't say yes right there on the spot, there's 20 people standing behind you saying yes. Okay. So don't put a lot of thought into it. If the numbers are right, it feels right. And I don't put a lot of thought into it. When I'm buying a property, I look at the pro forma. I look at the photos of the rehab, if there are any. I get on the Google Maps, go look at the neighborhood. I get on the Google Earth, where is it positioned in the city? That's how I make my decision. It's no brain surgery. I don't get analysis paralysis with all these spreadsheets and cap rates and cash on cash and all. I just don't do that. It's just a mental thing that's built in for me, but don't take my word on how I do it.
No, but that's funny because that's a really good point. It took me 6 years from the time that I read the little purple book, in 2009. It was actually 2015 when I bought my first property. And obviously I've missed the entire, run up to 2015 at least. And the reason was because, there's a finance, MBA, and I kept thinking about all the different things that could go wrong and all the different numbers. And I started noticing, listening to Bigger Pockets, that some of the most successful folks out there didn't really, I guess they didn't really think 10% of what I was thinking during that time, and yet they ended up with way more property and doing really, really well.
I would say that we're gonna thrive. The market's gonna thrive for another 2-3 years, in my opinion. If you hear all these rumors about the market's busted, well, that's because of all that stuff going on at your old neighborhood. Doesn't have anything to do with where we're buying or even upstate. I mean, if their market's going to turn, California's going to be the first, or some up in the Northeast. But I think we're going to have a plentiful market for the next 2 or 3 years. I really do.
Yeah, and for real estate investors, if you have low vacancy rates in the market, if you have a low number of empty rentals sitting there, it's kind of a no-brainer. And there's areas of the country that are very stable with that type of stuff, and just makes sense regardless of what's happening with the economy.
Correct.
Graham, it was so great having you on the show again. It's always a pleasure because you're always a wealth of information and help a lot of our members kind of learn the basics, and then also what happens in the background that we don't see. And that's always the part that's interesting to see for me. Guys, a quick reminder, I'm no longer sending text messages out about our meetup. So you have to check your email. You have to make sure that info@club500.us is in your contacts, so you don't miss our announcements. As you guys know, our membership has grown tremendously over the last few months, and so it became really expensive trying to text everybody for these events. Graham, what would be the best way for someone to get in touch with you if they're trying to ask about loans or do business in the future?
My phone number is really the 24/7. It's 855-326-6802. You call, and like Peter just mentioned, even on the weekends, if I'm available, I'm going to pick that phone up. If I'm not, I won't. But if you leave a message, I will always call you back. So that's always the best way. And
855, can you say that again? 855?
Yes, 855-326-6802. My direct delivery.
Typing it down in the chat box below. So if you guys want to take a look at it there, if it's easier, you can copy and paste it there. I will also put Graham's email there as well. gparham@highlandsmortgage.com. So if you guys want to get in touch, I mean, like whether you need a loan or not, Graham's a wealth of information, so you guys can always ask questions. Nick Chambra is asking if you do New York.
Nick, I just don't have a lot of demand up there. I apologize. I'm in license in 32 states, and I'm not in upstate. I'm not in Wyoming or North Dakota. I'm sorry. I'm just not there.
Yeah, 32 states, not bad though. I'd say probably most all investing heavy states are you're going to be licensed in.
Yeah, exactly.
Good deal. All right, perfect. So we've got the phone, we've got the email. Thank you, Graham. Thanks again. Definitely not the last time you're on the call, and it's been a great time.
Always my pleasure. Go Cowboys.
Right. We'll see you guys next week. Bye.